I'm a co-founder and head of design for L4S, and distributed ledger product is, we call it Tapestry for now. And this is a presentation on the critical issues for blockchain or distributed ledger technology. And the issues I'm going to cover today are what's the potential of distributed ledger technology, the performance issues, the functionality, the ease of adoption requirements, identity as a concept, and security just on a small part, but I'll hand that off to Kami at the end. So when we're looking at the potential for distributed ledger, it really is aspirational. What the Internet Protocol achieved for communication, distributed ledger technology, will achieve for trading and commerce and all the transactional industries. What we're really looking for is a universal, consistent transaction protocol that can deliver, benefits of cost and risk within the regulatory frameworks. And as much as the internet opened the world to a whole new areas of products and services, a DLT transaction protocol could potentially do the same. However, when we consider potential versus reality, this is what you're often seeing in the headlines. You've got some use case with added blockchain, they're giving you a consensus algorithm, and it's coming soon, any day now. And this has been the headlines for a lot of years, and many of the implementations haven't got past the proof of concept phase or are implemented in very limited and specialized use cases. So why is that? Well, when we look at the performance, there's certain aspects to distributed ledgers or blockchain technology. Mining within the cryptocurrencies has a finite capacity, which means once that capacity is reached, you have a bottleneck and a delay. Most of the other solutions use consensus or voting, and that computationally expands exponentially, because if you have an average number of votes per node, as the number of nodes goes up with the number of votes, those two increasing numbers multiply together for the number of votes that have to be counted expands exponentially. And I can answer this in more detail later if people want me to. It has an unsustainable, continuously expanded active memory. The Bitcoin model was to have a genesis block and then a continuous hash link of blocks of transactions from there on. The problem is each of the transactions, and they're really balance changes, are recorded in a block in its history. So you have to keep the entire ledger in an active memory, and that's ultimately unsustainable. Protocols like Ethereum are over 1 terabyte, and they're only getting bigger. And they're really not handling that great of volumes of transactions that would be in many of the industries that they want to support. And mining and consensus have arbitrary latency. It takes a little time, 10 minutes in Bitcoin, but minimally, it could be an hour if you're waiting for 6 blocks, but if there's a backlog, it could be longer. Voting can take a few minutes or a few hours, depending on where your transaction is, and that causes a problem. And the reason I say they only partially solve the double spend is because although they prevent an amount from being spent twice, of the two transactions, one or neither is selected arbitrarily, and they do exist for a period of time. You really want to stop the double spend at inception, not some retroactive period later. And most people are looking at this as fraud rather than errors, which are usually the cause of double spends. And if you want your second payment to go through rather than your first, you have no choice in the matter. So why is the performance a problem? Well, if you look at these consensus systems, you have two parties that initiate and agree a transaction, then you have a group vote and organize the blocks, and then ultimately the nodes have to validate and update their copies of the ledger. So this is just a simple schematic of the process. So if you look at it end to end, there's the latency. There's no way you can get a transaction through this process quickly. And again, it's arbitrary in terms of timing. If you're looking at the scalability of the capacity throughput, you've got a multi-step, multi-person process. And I challenge anyone to name what I would call a high-frequency committee. There's no way you can vote on several thousand transactions, count the votes, and agree on the votes in anything but a longer period of time. And usually the records of higher transaction volumes are usually in ideal situations with the computations turned down. As far as scalability, I mentioned the expanding memory problem, which is ultimately unsustainable, and also the exponential increase of voting. So these are the reasons why performance is a problem for many of the current blockchains. You don't have to believe me. If you read their white papers, they actually admit it. Here is digital assets before it sort of withdrew, or it's been put in the back burner for ASX in Australia. Consensus algorithms remain an ongoing area of research and impact both throughput capacity and scalability. R3, the famous financial services protocol, we make a variety of choices and trade-offs. Scalability is a key outstanding question for Ethereum in capital markets, and Hyperledger has the question as well, in terms of its own performance. So these are their white papers from 2 to 4 years ago, and they admit the problem that they're still struggling with. As far as functionality, what's lacking? Well, they don't have a transacting period because there's a continuous link of blockchains. You may have an end of day in terms of calendar, but really the blockchain is just a continuous record. So there's no way of archiving it, and there's no way of doing a future dated transaction because you're only acting in the moment. And the idea of payables and receivables, which is key for financing, is just not present. And then many of these solutions, although they're referred to as distributed ledgers, don't have double entry accounting. The accounting is done later, which is done with an algorithm rather than doing within the ledger itself. And so therefore that affects any ability to transact in financing, which is lending is a big part of financial services, and fractional reserve accounting, if you don't understand it, it's the way that commercial banks actually create money out of nothing. Most people know about central banks printing money, but you should Google this and understand it. It's a part of our global monetary system and would be critical for any major solution. And then within the accounting, the idea of running a trial balance on a ledger, balance monitoring, or reconciling to it. If you reconcile back to these continuously expanding blockchain links, it's almost impossible. And I challenge anybody to take the Bitcoin network and say, when did you last run the trial balance, and check the actual, all the Bitcoin that are supposed to be there are actually there. And then because of these shortcomings, there's an over-reliance on smart contracts. And these are complex, vulnerable, off-ledger algorithms. It's key to say that they're off-ledger. Because once they're off-ledger, you need the copy of the ledger, the algorithm, and the output to justify anything that comes from them. And for audit reasons, you'd have to store all that information and data every day you want to prove it. So it becomes untenable. Ease of adoption. So you want the protocol to be asset process and lifecycle agnostic, whereas the use cases we tend to see tend to be customized. So you really want to get to a generic solution as opposed to a customized solution. You also want to be able to settle with current markets and practices, meaning that today's implementations usually have digitized all the assets and they're self-contained within their network. But if you're taking over, say, a bond market, you're not going to digitize all the bonds day one, so you're going to have to settle in the market or even settle network to network. So without that capability, you're not going to be easily adopted or taken up. And then transition is a process where you may move your records from one institution to another. So what if your protocol gets superseded by a better one? Again, I challenge anyone, if you've got records on Ethereum, how do you actually transition those records from Ethereum to another blockchain? And then ideally, you also want to be able to transition in your history so you can decommission your legacy systems. So these are all considerations for adopting a DLT protocol. Identity is an interesting area. There's a lot of progress. It's not critical for blockchains right now because there's many solutions for identity. The problem with identity is that your information is in a lot of places for security. But think of data as an asset, and really a digital asset is a data asset. So these ledgers are now accounting for data assets, which can be in many forms. It can be records, it can be votes. And identity is a special case of data assets. So this is a real opportunity. But like I said, there's solutions for it at the moment which don't have to be incorporated in a blockchain, but it's some area that we need to look at. And when you consider voting, I'm part of the Government Blockchain Association, and I work with the voting group. There's a technology company called Votes, V-O-A-T-Z. They've done work, and there's actually been elections for offshore military in West Virginia by the Secretary of State, Mac Warner. And in Utah County, there was a blockchain vote for mobile technology for disabled people. But in voting, you've got this thing of where you want to prove the identity, but you don't want the identity associated with the vote, although you do want to be able to check the vote. So you want to vote as cast and cast as intended. Within finance, there's regulatory requirements to prove your identity, but you don't necessarily want your identity associated with all your transactions in a public or distributed ledger. So that fine line between confidentiality and disclosure is a balancing act. And then in supply chain, normally the parties know each other, so there may be less issues of confidentiality, although there may be confidential information you don't necessarily want to share along the supply chain, but identity comes with it. These are all the sort of challenges that people are looking at in these different use cases. And the idea of a user-controlled identity is becoming prevalent, particularly in what is really, more and more open world and that we access through our computers and phones. And there's some interesting developments with what they call zero-knowledge proof, or ZK SNARKs. That's a zero-knowledge succinct, non-interactive argument of knowledge. It's a complex field that allows you to prove something without actually saying what it is, which sounds counterintuitive, and it is. But there's different ways that these can be put together to make some interesting ideas of covering identity, proving things, all confidentially. So there's a good area of research in that area. And then security, and I'm not going to take any wind out of Kami's sails here. I just want to look at it from an aspect of one of the first things I learned when I joined the Chase Manhattan Bank as a management trainee was that, you can't prevent collusion. You can't beat it. No process is incorruptible, which sounds very worrying. So obviously you disincent it by saying you go to jail if you do anything bad or wrong. But the things you can only do is to make it very hard to do, to corrupt or fraud or create errors, and make it easy to spot and correct. There's a thing called segregation of duties. You have input, verify, you have prepare, authorize. You can layer these controls, but there's no guarantee that any layer is competent or not involved in a collusion. So again, it's the spotting of it is the key, along with making it very hard to do, which distributors ledgers through their processes do to a certain extent, but you only need 51% or probabilistically that computing power to beat Bitcoin, and you only need a supermajority in a consensus to beat that as well. So they're not incorruptible. In fact, blockchains are what they call corrupt evident. I was lucky enough at one of the Blockchain Association meetings to meet Scott Stornetta, who is actually the co-inventor of what is blockchain. His 1991 paper is cited in the 2008 paper by Satoshi Nakamoto. And this idea of hash linking and a mutual record of timestamps. And what it is it's an append-only database. So how do you update a database so that it can't go, someone can't go back in time and change the updates? Well, they can, but the hash link acts as a sophisticated mathematical checksum and proves that it's been changed. So it's corrupt evident, but not incorruptible. Most assets are controlled by fiduciaries, and people forget this. You have your money invested by fund managers. You have your money with banks and brokers. They're not going away. You can't move currency without a banking license. You can't issue trade or finance securities without brokers. However, the people that are the banks and brokers may be different companies. If you'd have asked, the internet, the telephone companies 20 years ago, that their main competition would be that nascent online DVD delivery service and the nascent online bookseller, you wouldn't believe it. But because connectivity became a commodity and content became king, Amazon and Netflix became the competitions, and it's why the telephone companies all got in bed with cable companies. So the future banks and brokers could be telephone companies, could be technology companies, could be retail companies. Third-party roles. So a lot of these solutions have notaries, oracles, order services. That's, if I was a hacker, that's where I'd attack. And also they create legal issues because either they and the network have to indemnify everybody to say if they make a mistake, it's my fault and I'll pay for it. Or everybody has to have powers of attorney or liability with each other. And so the interconnectedness of these networks makes it crazy, So, and then the last thing I'd say is encryption key management, because, and I'll let Kami talk to that. But the idea is you know, the rate and number of key protection. And one of the reasons I'm not involved or, you know, with Hub Security directly, but I like their product because from a client perspective, it's a secure way of managing a high frequency key requests and usage. Anyway, so my last thing is, so what's the good news? I've seemed to have depressed you all and said blockchains are useless. But let's go back to the potential, okay? So if we revisit the potential, and we have deterministic lifecycle agnostic algorithms rather than smart contracts, if we can get rid of consensus and we have something that's called proof of consistency and completeness. Now this is consistency without consensus, and this is research back on a different framework with Google. Academic prove you can have consistency without consensus. So you get rid of all the problems of consensus and the inefficiencies. If you can have near real-time settlement, because now you're not voting on transactions, the transactions are just settling in near real time, you can have a linearly scalable process. It no longer runs into the brick wall of consensus. And you can have huge performance because you're limited by the network hardware. So we think we can do 100K plus transactions per second. We may even peak higher than that. We have transacting periods. So we've broken up transactions and balances, and we do periods like the financial records do today. And now we can do asset and history transition as well. And we have an airlock so that we can do network to market settlements, network to network settlements. We have asset lot accounting, which obviously is good for tax reasons, as well as many others. We can do future dated payables and receivables. And we can do event-driven accounting, reconciliation, and audit. Imagine real-time auditing your books. And we imagine this in a regulated B2B distributed network. So now, if you look at all those things as compared to the current processes, this does open up the potential of distributed ledgers. And the benefits are that we save huge amounts of risk and cost. There's huge amounts of collateral posted for transaction risk, cost just in financing and another transaction and the infrastructure that's required to run these things. You can have flexible financing in netting on an intraday basis. So we can create a whole new market around price discovery and liquidity for assets. And near real-time projections, accounting and audit, how much efficient and what's going to improve an industry with all those things. Universal asset applications, meaning it's asset agnostic. You have enhanced data analytics because you can enhance the data associated with an asset as it progresses in any of the processes, and particularly supply chain. And if we can make the deployment simple and simple to use, then like the internet, it just becomes useful, and most people really don't know how the internet works. So if you look at supply chain, and I'll go through these quickly, you've got this centralized updates, deferred payments, limited data, inconsistent quality within sort of inflexible process. And not everyone may have access to all the supply chain data. And then all the payments are usually done later, 2 to 6 months later after delivery. If you look at the distributed ledger, you've got the idea of enhanced data traveling with the assets as they progress, and payments occurring at whatever time the financing is available in opposite direction to the distributed ledger, the digital assets going through it. And the nodes have the choice to, this node really only needs to worry about itself, who it delivers to, and who it received from. So you can limit access, but the owner or the interested party can, you know, see the whole blockchain or the whole network. And if this is particularly sensitive or external data, then if they're still using the same format, they can provide aggregate data to interested parties on a permission basis. We look at the capital markets, and again, I'm going through this quickly, so maybe you can go back to the video and freeze frame it. But the idea is you've got banks and brokers trading, but all those trades settle next day or 2 days, or sometimes with FX, you know, months in the future, you know, options and futures and everything else. Well, options and futures are always going to be a term contract, but the normal settlements take days. And so therefore you're managing risk and credit in that time frame. Within a near real-time settlement, you've now removed that risk, and you've got synchronizing execution and settlements in real time. So you have the benefits. And just to prove that we can, here's the diagram of us existing in both worlds, so we can settle to the market or within our network. So this is my flagrant advert, but here we are. We're better by design. We've got a proof of consistency and completeness and no consensus algorithm, and we are hopefully coming next year. So that's us, and those are the issues which we saw as requirements that had to be addressed. So thank you for listening, and I'll be interested in the questions later. My LinkedIn details have been at the bottom of the screen. My company page is there, and I'm sure that will be given out as well. And if you go to YouTube and Google the Blockheads Thoughts Distributed, you can see many of the videos on these topics.